Welcome back to Investing with Mackie. In this video, we're going to take a look at calls specifically for SPY that you could use to develop a covered call strategy to develop maybe weekly or monthly income depending what your goal is, and then how you can use this data to predict or plan out your potential earnings. Now, obviously, there's risk in any strategy, so the numbers we're looking at here are all hypothetical depending on how the market moves and reacts. These would by no means be guaranteed, but by looking at the data, you can help to figure out a strategy that you might want to implement. So first thing we'll look at is the prices here. So these are the strikes. So each line is a strike, and we can see as time goes out across the bottom, those are expirations. So the further out you go, the more expensive these options are going to be. With a covered call, you're ideally selling options that are typically out of the money far enough that you think they'll expire worthless. So that being said, this data was pulled at about 3:50 today on Eastern time, and the price was 4.55. So we'll start off, and if you're using this website price probability, what you can do is you can, let's see if I can get that bar. You can double click on a value to get it to be the only value appearing, and then we can individually click to bring other ones back into view. So let's start, say, at the money, 4.55. And then we'll add maybe every $2 so we can kind of see reference lines of how some of these might look. So 57, 59. Say we'll go up to there. Okay. So now let's say that our plan is to try to sell monthly options because we want to make a certain percentage per month. Well, if you had 100 shares, which is what you would need to sell a covered call for collateral, you would have about $45,000 locked up. So if you want to make a percentage per month, let's say you want to make 1% per month, then we basically need to find an option that expires a month out that would be worth 1% of our 40,000. So we can kind of look around and scroll, and we can see that the strikes are, say, 4.55. You can see the ones we selected, and the number left of it is the cost per share, right? So if we want to say look at a month out, we can kind of zoom in by clicking and dragging, and being the end of November now, we can take a look at the end of December, and we can see, say, the December 29th, that if we sold the 4.57, we'd be able to make $481 on that. Okay. Now I'd say that's pretty risky because we're looking at the current underlying price of 4.55. That may or may not expire in the money when that rolls around. So maybe we can kind of look at a shorter time frame and say, let's say we want to do, 0.25% on a weekly basis, right? So more often, but less per time period, right? So 1 week out, right? So today was the 30th. We'd be looking at the 7th of December. So let's zoom into here. Let's get that height scale adjusted a little bit so we can kind of see those lines a little bit better. December 7th. Okay. So if we were trying to make that 4-ish%, we'd be looking at about $100 per week, which would be $400 per month. Okay. So we can see, there we go. It looks like we're getting a little bit closer. So the 459 now gives us the ability to make $122 per week, approximately, right? And we're $4 from the strike price. Okay, so that might be a better option for us. I would say that's probably still too risky for me. But if we want, we can drop in, say, maybe the 460. See where that sits. That's $93. So that's about $5 above the current price of SPY. And we get $93 per week, essentially, if we stick kind of with that range. So that's pretty good. So let's kind of go with that for now. So now we can see that the 460 is something we might be interested in. But how do we actually develop this theta decay? Well, there's a Greek called theta, which we can look at to see how the decay actually works over time. So if we scroll down, we can see our theta data. And like we just talked about, we're kind of interested in that 460. So once again, we'll double click to hide everything except the 460. And then we'll add a couple on either side just as a point of reference. And we'll zoom in to, say, a month, 2 months out. And so we can kind of see that theta is pretty steady here. So this is what our daily theta is. So we can see we're at the 463. Our daily theta is 7.6 cents per share for 100 shares. That gives us about $7.06, 60 cents per day. So over a week, 7 days, we're looking right, not quite near 100. But as you go down to that 457, we can see it's almost $9 a day, $9.50 a day. As we get closer to expiration, those numbers start to increase. So we can see that's why as we shifted closer to expiration, we were able to make more money in those weeks. So what you're thinking now is, this is pretty awesome. I can just sell short-term options and I can get a lot more theta decay. And that's true. But the thing we need to take in consideration is the delta. Okay, so we'll scroll back up and we'll look at our deltas here. And what we'll notice when we look at deltas real quick is that as you get close to expiration, they start to spread out, getting closer to 1 and closer to 0. So what that means is a smaller movement in the underlying will create a greater price change in your option, which means you can blow away all the money that you've been making via the theta decay a lot easier. Okay. There's also gamma. Gamma is a little bit more confusing, but essentially it's the rate of change per dollar. So that also increases as you get closer to expirations. That's why we can see some increases and jumps in there. But that is what explains kind of this delta increasing. So with that being said, let's go ahead and take a look at those deltas. Right, we're looking at that 460. Add a couple around it. Okay, so we can see, right, the deltas start to get, in this case, heading towards 0 because they're out of the money. But say we're trading that 458, right? We're starting to get larger price swings if that price were to come up on the underlying. Okay, so these deltas are about 0.4. And then as we go down, we can see they're getting further from 0, but they're also dropping significantly in price. Okay, so the thetas are reduced. So you hear people saying, oh, I want to trade maybe a 0.3 delta or 0.2 delta. We can see, well, if we're doing, about a week out, the 0.3 delta is $458, which to me, a week out, as volatile as SPY has been, doesn't seem like that's a safe bet at that 0.3. But we can see that a week out on that theta, we don't have the 458 up here. We can see December 7th, right, 458, we're making $17 a day due to that theta. So ultimately, what I think is a good strategy to kind of optimize this delta and the theta is to essentially go 2 weeks out on your options. So somewhere around right the 14th or 15th of December. And then you close it right somewhere around December 8th or 7th. We can start to see that's when the theta starts to decrease for our out of the money options. So we kind of maximize this bottom of our theta. So at 2 weeks, then we close out at 1 week. And then what we're doing is we're also, if we look at our deltas, we're kind of optimizing where that delta is. So if we go ahead and add them all back in, well, there's going to be way too many. But we can kind of see that our deltas go back to that 0.5 the further out you are. So we're reducing a lot of that potential volatility in price by trading this theta that's not so quite or so close to expiration. And it also helps to optimize that theta because we can see the theta starts to decrease for our out of the money options as we get closer to expiration. So as you look at this data, feel free to pull up this page, kind of poke around and experiment a little bit. But I would recommend if you're looking at, say, like a weekly call or weekly income, you actually sell options that are 2 weeks out, and then you close them at 1 week and then reopen them again 2 weeks out. That allows you to optimize a little bit of the theta, reduce your risk because you're a further out time frame, and then go from there. So you can do the same thing for monthly options. You can say, all right, well, I want to go out a month, so look at December, and then you can maybe add, a little bit of buffer, add like a week or two. So it's not that big of a difference, right? Say you're looking at that 463, right, 0.76, right? You add a little bit of buffer, 0.75. In this case, 0.78, there's actually looks like a decrease in theta right here. So you can kind of look at that and figure out where the ideal spot is to determine what your daily income will be, and then what the income of the entire option will be, depending approximately when you would close and open. And all these calculations are considering the price stays the same, which it won't, but it allows you to look at the options a little bit and make a decision that best fits your risk profile. So if this was any interest to you and you gained anything, feel free to like the video, subscribe so you can see some of my other videos as I push them. And then check out my site, Price Probability, in order to check out the data yourself and see if it's useful in helping you determine plays that you might want to make.